The national debt right now is up almost really darn close to $2 trillion since they raised the debt ceiling. And it took almost 210 years to spend our first or to go into debt for our first $2 trillion, and we did it in a few months. This is reaching a pace of stupidity, and it's going to begin to really affect the banks. I truly believe it will be the catalyst for whatever comes next, and keep an eye on it. The end of the last chapter in the story of this banking crisis.
Popular precious metals analyst Andy Schectman is preparing for another U.S. banking crisis, similar to the April banking crisis that led to the second, third, and fourth largest bank failures in U.S. history. Andy reckons there are enough signs that the crisis is far from over. One of these signs, the Miles Franklin president explains in a recent interview with Liberty and Finance, is the massive decline in bank deposits over the past week. Earlier in the week, macroeconomics commentary outlet the Kobeissi Letter reported that U.S. banks have just had massive weekly deposit outflows. According to the research outlet, total bank deposits on a seasonally adjusted basis decreased by over $70 billion last week alone. It also noted that bank deposits are now at their lowest levels since May. Joe Consorti, a market analyst at the Bitcoin Layer, also made a similar announcement in a recent post on social media platform X. He wrote, U.S. commercial banks lost $71.2 billion in deposits last week. If this was 2008, that would have been the third largest outflow during the entire Great Financial Crisis. Since the March 2023 banking panic, it's only the eighth largest. Troubled waters lie ahead. Consorti further noted that the deposits are going into higher-yielding instruments like money market funds, showing that the Fed's rate hikes are still wreaking a lot of havoc in the banking industry. Where is it all going? He queried in a follow-up post. 60% of it is going into higher-yielding, safe and liquid money market funds that are yielding 4.5% or more. MMFs saw $41.8 billion of inflow last week. Report also shows the balance of unrealized losses on securities at FDIC insured commercial banks rose by $43 billion, or 8%, to $558 billion in the second quarter of the year. Experts say there would be an even worse scenario in Q3, since 10-year Treasury yields have closed higher. Andy agrees that the pressure in the banking sector will be heightened as the year comes to an end, and he doesn't rule out another wave of massive bank collapses. We will now bring you clips from the interview. Please watch, share, and like this video. Also, ensure you subscribe to the channel and turn on post notifications for more videos. Thanks, and enjoy the video.
I think higher rates are going to become a self-fulfilling prophecy because a lot of these holders, this is what we're seeing continually, are switching their 1% or less yielding bank accounts to T-bills and that are yielding 5%. And that's why the banks have to sell their loss-making, long-duration treasuries just to be able to pay those deposits that are being withdrawn. And this will force constantly higher interest rates for those long-term treasuries, and thus much larger losses on the treasuries or these unrealized gains. The whole banking system will get obliterated. And if you look at what's happening, just last week, we saw on a seasonally adjusted basis that bank deposits plunged by another $70 billion just last week. And so even more concerning is that in 6 months' time, and this is mostly to the smaller banks in the United States, they need to find $108 billion, these banks, because the bank bailout funding program has to be paid back in 6 months. And so there is going to be a lot more in the way of fireworks with the banks. You're seeing money just flee out of the banks, but maybe even more leaving not only the reverse repo market, which all of the money market funds are going into from the regional banks, going into the commercial banks, into their money market programs, which are being allowed to invest in the overnight repo market, which they shouldn't be allowed to do. The Fed should have stopped that a long time ago. It really would have put a brake on the exodus out of the regional banks, because as we've said before, you get 1% or maybe 0.5% in a savings account in a regional bank with the ability to go to a commercial bank that's too big to fail, paying 5.5% in the money market with daily liquidity. Why would you stay in a regional bank? The best rate you can get in a regional bank carries a 1-year CD at under 5%, locked in for a year. No reason to stay there. But all the money leaving the commercial banks going directly to the Treasury and even draining down the overnight reverse repo market, the money in there pulling out, going directly to the Treasury because they're paying a higher rate than the 5.3% or thereabouts you're getting in the overnight repo market. You can get more than that in a 3-month Treasury. And, it's crazy because at the beginning of 2022, that 3-month Treasury was 0.06%. And now it's 5.5%, which is more than the overnight reverse repo market. It is draining the reserves from the banks, and it's a big deal. I truly believe it will be the catalyst for whatever comes next. And keep an eye on it. The end of the last chapter in the story of this banking crisis is far from being over. So, yeah, that's what I will stick to. It's going to be the catalyst for the next problem. And it's going to start right there with rates rising and money leaving the banks, making rates rise higher, which puts more pressure on the banks. And it's just going to obliterate the whole system.
Another indication of an impending banking crisis is a recent announcement by the St. Louis Fed, which recently revealed that the Federal Reserve's Bank Term Funding Program has reached a peak of $107.8 billion. The BTFP was created in March to make additional funding available for bank bailouts. The Kobeissi Letter reports that usage of the Fed's emergency bank funding facility increased by $328 million in the last week alone. This in itself is adequate evidence that the banking crisis is far from over. It is not just blown apart because of the Fed's sneaky intervention. But how soon can the Fed continue these bank bailouts unnoticed while small businesses are folding up daily as a result of its policies? Let's get back to Andy's interview.
You're foolish to have lots of money in a regional bank, period. And, this is something that I really do believe, based upon what looks like the Federal Reserve aiding and abetting the exodus out of the banks, that this is something that they have drawn up. They want to cull the banks. They don't want 4,500 banks. They want 4 or 5 banks. And you do that, all it will take is one big bank like a Schwab or a PNC or any of these banks that are really very much in trouble. You look at Schwab as an example. Everyone's, oh, there's no way that'll happen. Well, they borrowed 130% of their assets in this funding program. It's due back in 6 months. Where's the money going to come from? I find it interesting that all of the money that was in TD Bank just went over to Schwab, or in their brokerage accounts over to Schwab, because they bought them or whatnot. All of these deposits will help reliquify Schwab, but is it just buying time? I'm not quite sure. But look, the bottom line is that there will be a big bank failure, a PNC or a Truist or a U.S. Bank or one of these banks, and they'll bail them in. And when that happens, I think you'll see chaos and panic, unlike anything any of us have ever seen, because it was bad enough and scary enough when the banks were bailed out, as they should not have been. Read the Dodd-Frank law. That was not how it should have gone down, and it did. We've covered that, ad nauseum, but this time, I think you're going to see a bank bail-in. I've been pretty consistent with that. I think you'll see that. And when that happens, I think all bets are off. You'll see rates really rise then, because everyone's going to yank their money out in a fever pitch. And that goes back to what Kristalina Georgieva said, the head of the IMF, who said, the problem in the U.S. is the fact that people can move their money too quickly with the click of a mouse. Well, good luck this time. You see a bank bailed in and watch how fast that happens. And I think you will see a bank run like no one has ever imagined, which will immediately collapse not just 1 or 2 or 3, but a lot of banks, because there are people that are thinking about this, and they just forgot, and they haven't gone and done what they wanted to do. To transfer out takes some time, it takes some effort, got to open up an account at a too big to fail bank or whatever it is. And I think that will light a fuse not only under the banking system, but certainly under a lot of people's feet. What I'm getting at is that everything is upside down, and it bothers me to no end. And I think this is part of the greater picture that is not lost on our adversaries and on our allies, who are wondering, like many of us are, what the heck's going on with the U.S., the foundation of liberty and of justice and of respect respect for the law. These things are more troubling to me, and this is not a political statement. This is about being a patriot in a country that has afforded me and my family opportunities that I pinch myself and can't even believe that we've been able to maximize. But I love this country, and I'm more disturbed by what I am seeing with the ripping of the fabric of this country and the fact that we aren't unified the way we were, like, for example, after World War II and the Great Depression, where we came back stronger than ever and made the world look at the United States as a place of, envious of what we had and how we went about our business and how we respected the public, the law, our families, religion. Everything that made this country great is now up in the air.
Since gold hit a record high of $2,078 at the peak of the bank crisis in May, there has been a general consensus that another hint of trouble in the sector would cause a massive spike in gold prices. This is no mere hint of trouble. What we have here is strong evidence that the banking sector is heading for some deep trouble. Do you agree that we are heading for another 2008-style banking sector collapse, as many reputable institutions, including Morgan Stanley, have predicted in the past few months? How do you think such will impact gold and silver prices? Please share your comments in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.